Hello class, and welcome to the video lecture for Notes Receivable and Notes Payable. Learning Unit 2 covers journalizing entries to record the renewal of a note, dishonoring of a note, receipt of payment, and notes given in exchange for equipment purchased. Let's go over the example in the book, which starts on page 523. On August 1st, Mace Company sold $6,000 of merchandise on account to Jane Company. It's very important to determine who is the seller and who is the buyer before you begin. The seller will have an accounts receivable because the seller is the one selling the merchandise and will receive payment from the buyer. The buyer will have an accounts payable because the buyer is the one buying the merchandise and will pay the seller. To review the rules of debits and credits that you learned in Accounting 110, an increase in accounts receivable is recorded as a debit, and an increase in accounts payable is recorded as a credit. Mace Company is the seller and Jane Company is the buyer. Mace Company will record an increase in accounts receivable with a debit and an increase in sales with a credit of $6,000. So Jane Company is the buyer. Jane Company will record an increase in accounts payable with a credit and an increase in purchases with a debit for $6,000. On September 1st, the end of the credit period, Jane Company gave a $6,000 60-day 13% note to Mace Company to gain additional time to settle the past due account. This means Jane Company, the buyer, issued a promissory note to Mace Company that would pay the bill in 60 days. Mace Company is receiving the note, which replaces the account receivable. Now Mace Company increases notes receivable with a debit and decreases accounts receivable with a credit. Jane Company is issuing the note, which replaces the accounts payable. Jane Company increases notes payable with a credit and decreases accounts payable with a debit. Now let's look at the journal entries that will be made if Jane Company pays off the note on October 31st, which is the maturity date. Mace Company, the seller, will receive cash from Jane Company. This reduces the notes receivable on the books on Mace Company, which is recorded with a credit to notes receivable. But now Mace Company also receives interest. Remember, interest is principal times interest times time. Interest is principal times rate times time, which means 6,000 times 13% times 60 days, which in terms of a year is written 60 over 360. If you enter that into your calculator, you get $130. This is interest received by Mace Company, which is recorded in the interest income account as a credit. So how much cash is received by Mace Company from Jane Company? The total is the principal of the note plus the interest income for a total of $6,130. Now let's look at how Jane Company records this payment of cash. It reduces its notes payable with a debit of $6,000. It then records the amount of interest it pays as an expense with a debit to interest expense of $130. Then it credits the amount of cash it pays, $6,130, with a credit. Now let's look at what happens if Jane Company is unable to pay the $6,130 at maturity. It's possible for the company to renew all or part of the note. Let's assume that the company can pay the interest of $130 and give another note for 90 days at 13%. So Mace Company records the cash it receives with a debit. It only receives $130. It cancels the old promissory note with a credit to notes receivable and records a new note with a debit to notes receivable. The same general ledger account is used, but since the terms of the note have changed, it records it as if it were a brand new note. The cash it receives is interest income, which is recorded as a credit. Jane Company cancels its old note payable with a debit and reissues a new note with a credit to notes payable. It also records the payment of the $130 cash as interest with a debit to interest expense and a credit to cash. Now let's look at what happens if Mace Company does not renew the note and does not pay. In this situation, the note is said to be a dishonored note. Another way to describe this situation is to say that Jane Company has defaulted on its note. On Jane's and Mace's books, the amounts in notes receivable and notes payable will then be removed and transferred back to accounts receivable and accounts payable because the note has reached the maturity date. At the same time, whether the note is paid or not, the interest expense is still due and payable and should be recorded. For Mace Company, this is interest income, and for Jane Company, it is interest expense. Let's see what entries would look like if Jane Company finally pays the amount owed on December 1st. To keep it simple, no additional charges will be calculated for the extra month Jane Company has taken to pay off the amount owed to Mace Company. Mace Company records the receipt of cash with a debit and a reduction in accounts receivable with a credit. Jane Company records a reduction in accounts payable with a debit and a reduction in cash with a credit. The last part of the learning unit is recording notes when an asset is purchased, such as store equipment. Suppose Jane Company decided to buy from Ronald Company some display racks for $7,000. In this case, Mace Company credits the income account sales instead of accounts payable, and Jane Company debits store equipment. All of the entries at the maturity date would be the same. So that wraps up Learning Unit 2. In Learning Unit 3, we'll cover discounting notes.